Today, I want to talk about fast retailing, a Japanese fashion giant that shows every sign of a great compounder but is not so well known in the Western world. In the last 4 years, they could grow their dividend with a whooping 25.7% per year. And while other fashion giants are struggling, they have just reached new record highs in sales as well as revenue. So, in today's video, I want to see if they are not only a good company, but also a good long-term investment. And for that, I will have a look at their business model and markets, analyze their MOAT, and look at the latest financial statements. I'll also check their valuation to see if now is a good time to buy. So, sit back, relax, and let's explore fast retailing's investment potential together. I am Florian. Welcome to Cashflow Maniac. The ticker symbol of fast retailing on the Tokyo Stock Exchange is the very intuitive 9983. But on the OTC you can get it as FRCOY. They are working in the consumer discretionary sector and were founded in 1949 already. At the moment they have almost 60,000 employees and their headquarters sits in Yamaguchi, Japan. The market cap is at almost 100 billion US dollars right now. The total returns of the company in the last 12 months were almost exactly the same as the S&P 500, which is actually not too bad when we speak about a Japanese retail company. But the volatility on the other hand was much higher. So the individual performance of investors in the company largely depends on when exactly they bought the stock. Over the last 10 years, the company did underperform the index though, with 160% total returns versus 240% from the S&P. Maybe it is a bit mean to compare a Japanese consumer discretionary company to the tech-heavy S&P. But as one of the best performing standard indices, I just like to use it as kind of a baseline. So I compare all companies to the S&P as well as their peers, which we will come to later in the video. At first, let's have a look at their business model to understand what the company is actually doing and what sets them apart from their competition. In the case of fast retailing, they are all about essential and timeless clothing that is designed to fit everyday's needs. So their product design focuses on functionality and simplicity with a minimalistic design instead of the always changing styles to meet the latest trends. They are also putting a huge focus on delivery speed and consumer satisfaction, which leads them to using the latest technology in their shops, such as quick self-checkout with in their products embedded RFID chips to speed up the shopping experience. In parallel, this also helps with accurate stock tracking and increases their efficiency. But what sets them apart from their competitors most are their minimalistic and functional products instead of the always changing styles with the need to meet the latest trends. With this focus on more basic products, they don't need to change their lineup so often and are able to leverage the economy of scale and sell high quality products at reasonable prices. One example of this functional clothing is the Heattech line that they developed for 20 years already, and that combines different threads and fabrics in a clever way to turn water vapor molecules emitted from your body into heat and trap the warmth inside the yarn to keep you warm. Fast retailing operates with 4 major brands. The 2 biggest ones are Uniqlo Japan and Uniqlo International that together make up almost 80% of their revenue. But they also have 2 smaller brands with GU and global brands. What I find interesting is that the revenue portion of the Uniqlo International sales has steadily increased since its inception almost 20 years ago. Compared to last year, this international business did increase by 3% compared to the overall revenue. So the company is really putting a huge focus on expanding their international operations and getting their brands and especially Uniqlo to be noticed around the world. Today, 67% of their shops are out of their home market in Japan, with a huge focus on the Chinese market where most of their stores are located. And this is especially noteworthy because we saw the exact opposite trend with some other companies like LVMH or Kering that I recently analyzed. In these cases, the revenue was shifted more from the international and especially the Chinese markets to Japan due to the very favorable exchange rate to Japanese yen. Here you can see the exchange rate between euro and yen, but the graph USD to yen looks almost the same. So, while other companies and especially luxury brands are struggling with their international sales, fast retailing's overseas business is thriving right now. And you might think now, well, Florian, this is probably because they produce in Japan and the weak yen makes it possible for them to export their products very cheaply. But this is actually not the case. Because, like many other clothing brands, their production is outsourced to places like China, Vietnam, Indonesia or Bangladesh, where they monitor the production on a weekly basis. Another trend in the fashion industry is the use of second-hand clothing and upcycling. Well, Fast Retailing and Uniqlo are currently implementing re-use studios in their stores where they repair worn or even remake old clothes. This was just started in 2022 and by now 35 of their stores have such re-use studios. What I also find quite interesting is the fact that their store count has remained largely the same since 2019, while the revenue could still grow each year after the pandemic and has reached new record highs last year and also this year again. In the Q&A session of their last shareholder meeting, the CFO of Fast Retailing mentioned that they are currently focusing on the qualitative rather than the quantitative nature of their store network and run with a scrap and build strategy where they close smaller stores and stores in less favorable locations and instead open up bigger stores in better locations. And when looking at the numbers again, this strategy seems to be working quite well for them. As additional benefit, this discipline with shop openings has also led to an increase in the margins, as we'll see when we come to the financial analysis in a minute. But before coming to the financials, let's first have a look at the fashion market in total. McKinsey has recently forecast the year-over-year sales trend in the luxury as well as the non-luxury markets. And their prediction for next year is that the revenue growth across this segment will stabilize next year with low single-digit growth worldwide. And compared to the last years, this trend should be driven by non-luxury retails in contrast to the growth in the last years that was mostly driven by luxury fashion. The general global fashion market until 2030 is expected to grow with a CAGR of 4.1%, which is almost 1% higher than the market in the US that is expected to grow with only 3.3%. And with their key areas being China and Japan, Fast Retailing has the chance to benefit from a slightly higher than average growth across this market. But the overall growth trend is still not too large. When we look at the strategic position of Fast Retailing within this global fashion industry, the first thing to notice is the very high competitive rivalry. And as we saw recently with Temu's success, it is quite easy to emulate copy the fashion of other brands. And this is true even for more technology-driven products like the Heattech line that we saw before. And most of Fast Retailing's hot topics like sustainability, quality and price are very common themes in this industry and they are not alone in their efforts. It is still not too easy to enter this market as a new company, and Fast Retailing can definitely benefit from the economy of scale and their good reputation. But the many already existing fashion companies do have an impact on the pricing from supplier side as well as consumer side. So overall, I think that the company faces strong pressure from their competitors as well as their consumers. I would still say that they have a small moat from the Uniqlo brand, which is well known in Japan and China, but that's about it. These are also the general struggles of the fashion industry and one reason why I don't like the whole industry too much. But now that we understand their business model and the general market trend, let's dive into the financials to see if they could implement their strategy successfully in the past. And to really see how their fundamentals are progressing, I am looking at the numbers in Japanese yen here to not have any additional effects from exchange rate changes on these numbers here. As a first step, I'm looking at the income growth and we see a very nice and steady growth across the board. But not only that, in parallel to the slowdown in the growth in store count, the company could also manage to keep the costs of operations pretty stable since 2019. And to me, this is at least a good indication that their focus on efficiency is working pretty well. Overall, this resulted in 5-year average growth numbers of 6.2% for revenue, 10.2% for free cash flow, and 17.9%, so almost 18% for EPS. In the last fiscal year that the company reported at the end of August, the numbers looked even better. Here they show a year-on-year revenue growth of even 12.2% and a growth in their operating profit of 31%, while the earnings per share did increase with still impressive 25% in the last year alone. And as already hinted at earlier, they could also increase their margins over the same time frame, as we can see here for the EBITDA margin and the net margin. The free cash flow yield and the return of invested capital are fluctuating a bit, but are largely still stable. So at the moment, they are sitting at a free cash flow yield of 4.14%, an EBITDA margin of 22.2%, and return of invested capital of almost 15%. And these margins, as well as the net margins, are all pretty good for the fashion industry. We'll come to the full peer comparison in a bit, but just to give you some context, the margins of Adidas, which is far more recognized in the Western world, are nowhere near those of fast retailing, except for its free cash flow yield. And rather than improving, Adidas margins are clearly trending downward. What is also very nice to see is that the company has a clean balance sheet and at the moment more cash than long-term debt on their hands. And even better, they have almost as much cash as total liabilities, which now gives them a very safe business that still has a lot of room to increase their spending if necessary. The company is not buying back any shares and their share count is largely stable with a small dilution of 0.04% per year over the last 5 years. They are still rewarding their shareholders with a small dividend of 0.81% yield, but the growth has been very significant with 25.7% growth per year over the last 4 years. And they did manage all this while at the same time keeping quite a low cash flow payout ratio of only 18%. And as a side note, please be careful when you check this data by yourself, because I noticed that Seeking Alpha, for example, doesn't include the 3-to-1 stock split the company had in 2023. So the dividend growth they state on their page is actually not correct, and so are the years the company has grown the dividend. In reality, the numbers and the trend are much better than what Seeking Alpha shows us. And this makes the stock look much less attractive for dividend investors than I believe it actually is. So now that we know the current status, let's dare to have a look into the future. Here, the company itself predicts that their business should grow quite a bit slower than what we saw this year. But it is still a bit above their 5-year averages with a high single-digit growth in revenue. And while this is quite a drop from last year's numbers, they still expect to reach new record highs in revenue as well as their sales volume next year. And this outlook is also reflected by analysts. The 14 analysts that cover the company expect an average 1-year price target that is roughly 8% above the current stock price. But the maximum expected upside is with 32%, much higher than the downside with only 8%. They also expect an EPS growth of 5.3% over the next 4 years and a revenue growth of 5.2%. This is again quite a bit below the expected values for next year and seems to indicate that analysts see the long-term growth of the company with mixed feelings. But please don't forget that analysts are a fickle bunch and are adjusting their targets on a very regular basis. So while I always find it interesting to see what the expectations are, I wouldn't bet too much money on this. In general, the picture shows a slowing growth for the company. Unfortunately, we are also not the first ones to notice fast retailing's strong recent performance, and this is also reflected in the current valuation. Their PE ratio sits at 37.4, their EV to EBITDA at almost 20, and their price to cash flow ratio at 25.6. These are all way above the sector medians, and I find these values crazy high for a fashion company. Usually I also show the company's own valuation history here, but it was not so easy to build the graphs for fast retailing. This is probably because we are talking about a Japanese company, and I use a combination of US and German sites and tools for my analysis. So I calculated the 5-year averages by myself, but because of it, I cannot show you the exact trend, unfortunately. The average PE ratio of the last 5 years was still even higher than the current valuation, and the same is true for the EV to EBITDA. The price to cash flow ratio today, on the other hand, is even higher than the 5-year average value of 21.5. Last but not least, before we sum this up and come to our conclusion, let's also compare fast retailing to some of their closest competitors. And if you find this video interesting, please hit the like button and subscribe to the channel so you don't miss out on my next analysis. It also helps me out a lot and it doesn't cost you a thing. So thank you very much. For the peer comparison, I choose TJX, Inditex, the mother company of Zara, Pull & Bear and Massimo Dutti, Gap, H&M and Adidas. And from this group, TJX did produce the best total returns over the last 10 years, followed by Adidas. Fast Retailing and Inditex are both right in the middle of the group with around 150% total returns. If you're looking for a high dividend payer, the company is probably also not the right choice with their smallish yield of 0.8%. Besides Adidas, they are the ones with the second lowest yield from this group. But the dividend growth paints a totally different picture. Here we see that half of the companies in this group have decreased their dividends in the last 5 years. And while the value here for fast retailing doesn't seem to be too huge, I just showed you the real numbers when also accounting for their stock split. And in this case, fast retailing is with their huge and almost 26% growth rate the top dog here with quite some distance. Valuation-wise, we already saw that they are quite a bit more expensive than most other companies in this sector, and we see the same here in this direct comparison. While some other companies come close in individual metrics like TJX in price to cash flow and Adidas in forward PE, overall, fast retailing is the most expensive one here. But on the other hand, we have the growth, where they are also the ones with the highest growth rates in revenue, EBITDA and EPS. Their net income is only ever so slightly behind Inditex. Profitability-wise, they are also the second ones, and only Inditex has even higher margins. But depending on the metric that you're looking at, the distance here is not too huge. So overall, I think that fast retailing is a very interesting company, especially if you're looking for high dividend growth. The fundamentals look solid, and even though their growth in the next years is expected to go down a bit from the very high values that we saw over the last years, it still looks solid. Their store strategy also seems to work pretty well, and I think that it's very impressive that they could keep growing at the rate they did, while at the same time improving their margins. And they did all this in the fashion segment, where many other companies are struggling right now. But this could turn pretty quickly if new trends emerge in the fashion industry, and the basic clothing they provide could also be replaced pretty easily from other companies. So their moat is not too huge, but I also think that this is true for most other companies in this segment. That is also my main reason why I'm not invested in any fashion company. I just find this industry too dynamic and short-lived to pick one specific company as a long-term investment. But that is just my opinion. What do you think about the company? Do you like it? Or do you have any better alternatives? I would be really interested to hear your thoughts down in the comments. And guys, I'm trying to be fully transparent about my investments on this channel. So I just released a video where I go over my whole dividend growth portfolio as well as my reasoning and strategy behind it. So if this is something you find interesting, you should check out the video. That being said, thank you so much for watching guys, and see you in the next video.